Hi, I'm Adrian Johnson.
My name's Nathan Meggie.
Our company was Bricktown Brewery. I picked that company because it seemed pretty simple. They were going public pretty soon, and all their information was pretty simple. So my role was taking the valuation with the DCF approach. I started finding the historical data of the company. I began looking through the S1 form on the SEC website to see if I can calculate the previous cash flows from years prior. I couldn't really find what I was looking for on the form, so I researched a little more. I did eventually find them. The information I found was really weird, though. It was in decimals, but I couldn't really find anything else, so I just took the decimals and began to use them in the same process where I would if they weren't in decimals. So after placing the three prior cash flows that I could find, I began to calculate the free cash flow growth rate each year. The final historical year grew at 50% as it went down from 100 to 50. Obviously, that's not realistic. I knew the cash flow would still rise, but not at this rate with it going from 100 to 50. So I used a growth rate of 25% for the next five projected years. To calculate the projected cash flows, I used the previous cash flow times the growth rate for each 5 years. My next step was calculating the terminal value. I said free cash flows would grow indefinitely at 2.5% due to the economy typically growing around 2 to 3% annually. Finally, I needed to calculate the WACC of the company. However, I was really struggling to calculate this, so for the purpose of just doing it, I put the WACC at around 7.7%. For terminal value, I used the most recent projection times the growth rate divided by WACC minus the growth rate to find my terminal value. The next step was discounting future cash flows. I calculated this by taking the cash flow divided by WACC to the power of the future year. To find the equity value, I took the sum of the free cash flows minus debt plus cash, which again were all in decimals for some reason. So finally, I took this number divided by shares outstanding to arrive at my value.
My role in this project was through the market-based valuation approach, and I started out by finding the revenue for the past 2 years, and then I found the gross profit and then the operating income. From these three figures, I was able to find net income. Net income for 2017 in millions of dollars was negative 1.26 million, and in 2018 it was negative 1.35 million. After this, I found the total assets, total liabilities, and total equity, which had me at negative 19.48 million. We, by doing this, I found out the enterprise value. So I took the share price times the number of outstanding shares minus the value, and I ended up with the enterprise value being around 51 million or 51.4 million. I then compared it to other companies, which were rival markets, such as Ballast Point Brewing Company, which had a market value of 17 million as of October 2019, Gordon Birch, which had a market value of 40 million, and then BJ's, which had a market value of 5.6 billion. But this wasn't really that comparable because BJ's was so much bigger of a corporation. Then for the second part of the project, I did a spin-off transaction to see if I could get more value and more bang for my buck from the stocks that we sold. So the market-based valuation that I found for the company was 51.4 million, and by conducting a spin-off transaction, I was able to take 15% of the shares times a premium share value of $10 that equated to 2.8 million, and this helped me out to get to a net profit of 50 or a net profit of added value of $500,000. By doing this, I was able to find that by doing a spin-off transaction, we could gain value with the company and increase the value for later years. Thank you.